Welcome back, everyone. John Smith here, and today we are diving into something that I think is one of the most underreported and genuinely fascinating stories unfolding in the financial world right now in 2026. And honestly, when I started pulling the threads on this one, I couldn't stop, because what's happening in the silver market right now is not a small story. It's not a niche story for gold bugs or precious metals enthusiasts tucked away in some corner of the internet. This is a story about how a physical commodity that the entire global economy actually depends on is being squeezed from two completely different directions at the same time, and most everyday investors have no idea it's happening. So let's set the stage here. Silver has always lived in this interesting dual world. On one side, it's an investment asset. People buy silver coins, silver bars, silver ETFs, just like they might buy gold. But on the other side, and this is where it gets truly interesting, silver is a deeply industrial metal. It goes into solar panels, electric vehicles, semiconductors, medical devices, and all kinds of electronics that we use every single day. That dual nature is what makes the current situation so unusual and so potentially significant. Here's what's been happening. Over the past couple of years, the amount of physical silver sitting in the registered vaults at the COMEX, which is basically the main exchange in the United States where silver futures contracts are traded, has been quietly but steadily falling. And when I say quietly, I mean quietly. It doesn't make headlines. You're not going to see this on the nightly news. But if you go and look at the actual vault data, which is publicly reported, the numbers tell a story that is hard to ignore. Now, before we go any further, let me just make sure we're all on the same page about what the COMEX is and why it matters. The COMEX, which stands for Commodity Exchange, is part of the CME group, and it's the place where massive financial contracts for commodities like gold, silver, copper, and others are bought and sold every single day. These aren't always people buying actual physical silver. A huge portion of the trading that happens on COMEX is what's called futures trading, meaning two parties agree today on a price for silver that will be delivered at some future date. Most of the time, these contracts never actually result in physical silver changing hands. The contracts get rolled over or they get settled in cash. It's a massive, highly liquid paper market. But here's the thing. The physical silver does exist. It sits in COMEX-approved warehouses, mostly in New York, and it's tracked in two important categories. The first is called eligible silver. That's silver that meets the standards to be used for delivery on a futures contract, but the owner hasn't offered it up for that purpose yet. Think of it like silver sitting in a warehouse that could be used but hasn't been committed. The second category is registered silver, and this is the critical one. Registered silver is the metal that has been officially set aside and is available to be delivered against active futures contracts. It's the silver that the market is actually counting on when those contracts come due. And it's the registered category where things are getting genuinely interesting right now. Let's break this down with a simple analogy. Imagine a restaurant that sells tickets for dinner in advance. People buy these tickets, let's call them dinner futures, months before they ever sit down to eat. The restaurant has food in the back, both food it owns and food that suppliers have designated specifically for ticketed reservations. Now what happens if the restaurant sells a lot of tickets, but the amount of food that's been specifically set aside for those reservations starts getting smaller and smaller? At some point, you start wondering whether there's actually enough food to honor all those tickets. That's roughly the dynamic we're watching play out in the silver market right now, just with billions of dollars at stake and a much more complicated cast of characters. So why is the registered silver inventory declining? There are a few reasons that analysts and market observers have been pointing to. First, industrial demand for silver has genuinely been rising. The global push toward green energy infrastructure, solar panels in particular, requires enormous amounts of silver. A single solar panel uses a meaningful amount of silver in its construction, and when you multiply that by the tens of millions of panels being manufactured and installed globally every year, you're talking about a real, sustained, and growing drain on the available supply of the metal. Electric vehicles, 5G infrastructure, advanced electronics, all of these are consuming silver at rates that the mining industry has been struggling to keep up with. Second, and this is where the story takes a turn that catches a lot of people off guard, the mining side of the equation has its own challenges. Silver isn't primarily mined as its own product the way gold is. The majority of silver that comes out of the ground is a byproduct of mining other metals, copper, zinc, lead. So when the economics of those other metals shift, silver production can slow down in ways that have nothing to do with silver's own price or demand. That creates a situation where the supply side can be somewhat inelastic, meaning it doesn't always respond quickly even when demand goes up. Now here's where we layer in the part of this story that gets really fascinating and, to be honest, a little complex. So stay with me here, because I'm going to walk you through this carefully. On the COMEX, there are entities, large financial institutions, hedge funds, trading desks, that are what's called short on silver. Being short means they've essentially made a bet that the price of silver will go down. They've sold contracts for silver they don't actually own yet, with the expectation that they'll be able to buy it back later at a lower price and pocket the difference. Now, shorting is a completely legal and legitimate practice in financial markets. It provides liquidity, it can keep prices from getting overheated, and there are often good reasons why sophisticated traders take short positions. I want to be really clear about that. This isn't inherently nefarious, but the scale of the short positions in silver futures relative to the actual physical silver available is something that analysts have been paying close attention to. Think about it this way. If the number of outstanding futures contracts on the COMEX represents a claim on many multiples of the physical silver that's actually sitting in registered vaults, and historically, this ratio has been quite elevated, then you have a potential mismatch that could matter a great deal if circumstances shift. Specifically, if more contract holders than usual suddenly decide they want actual physical delivery of their silver rather than just rolling over or settling in cash, the market could face a very real stress test. This is the core concept behind what people call a short squeeze in commodities. Though in physical markets, it's sometimes called a delivery squeeze. Here's how it can unfold. If enough buyers of futures contracts start demanding physical delivery, the shorts, the people who sold those contracts, have to scramble to find physical silver to deliver. If the available registered inventory is thin, they may be forced to buy silver in the open market to fulfill their obligations. That buying pressure pushes the price up. A rising price puts more pressure on the shorts because their losses are mounting. That can force more buying to cover their positions, which drives the price up further. And you can see how this kind of feedback loop can accelerate quickly. Now, has this happened before? It has, actually. Go back to 2021 and you saw a coordinated attempt by a large community of retail investors, particularly on social media platforms, to buy physical silver and silver ETFs all at once, trying to trigger exactly this kind of squeeze. That episode, which you may remember, caused a significant short-term spike in silver prices, and actually did cause the COMEX to report noticeable outflows from its inventory as people sought to take possession of physical metal. The squeeze didn't fully materialize at the scale some had hoped, but it demonstrated that the dynamics are real and that the market is not infinitely deep when it comes to physical metal. What's different in 2026 is that the conditions that would support a more sustained move have arguably developed further. Industrial demand hasn't let up. The green energy build-out has continued. COMEX inventories have continued to trend in a direction that narrows the buffer between outstanding paper contracts and available physical supply. And global economic uncertainty has kept investor interest in hard assets alive. Let me pause here for just a moment, because if you're finding this useful, if you're the kind of person who wants to understand how these markets actually work, not just the headlines, but the mechanics underneath, then go ahead and hit that subscribe button. We put out content like this regularly on the channel, breaking down complex financial topics in a way that actually makes sense. And if you want to help other people find this video, a like goes a long way. Okay, back to it. So let's talk about the COMEX inventory numbers a little more specifically, because I think it helps to understand the scale of what we're looking at. At various points over the past few years, the registered silver in COMEX vaults has dropped to levels that represent only a fraction of the open interest, meaning the total number of active futures contracts outstanding. The ratio of paper claims to physical metal has, by some measures, reached levels that are historically quite elevated. Now, most of the time this doesn't matter, because most futures contracts never demand physical delivery. The system works as long as everyone agrees to keep playing by the paper rules. But markets have a way of stress testing assumptions, especially when the underlying fundamentals shift. And here's something else worth understanding. When silver leaves the COMEX registered category, it doesn't always go somewhere trackable. Sometimes it moves into the eligible category, meaning it's still in the vault, but no longer available for delivery. Sometimes it gets shipped to buyers who want to hold it directly. Sometimes it goes into industrial supply chains. The point is, once silver leaves registered status at COMEX, getting it back into the deliverable pool is not always quick or easy. The metal has legs, as they say. Now let's talk about what makes this situation different from a simple supply and demand imbalance. In most commodity markets, if supply gets tight, prices rise. Higher prices incentivize more production, and eventually the market rebalances. That's Economics 101. But silver has a few quirks that make this slower and messier than it sounds. The first quirk we already mentioned: most silver is produced as a byproduct, so higher silver prices alone don't necessarily open the floodgates of new supply. The second quirk is the refining and processing pipeline. Even if new silver ore gets mined, it takes time to process it, refine it to the required purity, cast it into the standardized bars that COMEX requires, get those bars approved, and deposit it into a certified vault. We're not talking about days, we can be talking about months. So in a fast-moving market where contracts are coming due and delivery demands are rising, there isn't a quick dial someone can turn to flood the market with new supply overnight. The third quirk is geopolitical. A significant portion of the world's silver production comes from a handful of countries: Mexico, Peru, China, Russia. Any disruption to supply chains from those regions, whether it's regulatory changes, labor disputes, export restrictions, or broader geopolitical tension, can have an outsized impact on silver availability. This is not a theoretical concern. These kinds of disruptions have happened before, and they can happen again. So let's put the full picture together, because I think at this point, you can see why this is a story worth paying attention to. You have rising and structural industrial demand for silver from sectors that are not going away: solar, EVs, electronics. You have a supply side that can be slow to respond, and that has geopolitical vulnerabilities. You have a market structure, the COMEX future system, where a significant multiple of paper claims exists relative to the physical metal backing those claims. You have COMEX registered inventories that have been trending downward, and you have a history of short positioning in silver that is substantial relative to those same depleted inventories. None of these factors alone would necessarily be alarming, but together they create a set of conditions where a catalyst, a meaningful pickup in physical delivery demand, a large industrial buyer deciding to take delivery rather than buy on the spot market, a wave of investor interest that translates into actual removal of metal from vaults, could trigger a chain reaction that moves prices in ways that are difficult to predict. Now here's where I want to be really careful and really honest with you, because this is not a video where I'm going to tell you that a massive silver explosion is definitely coming and you need to rush out and do something about it today. That's not what responsible analysis sounds like. The reality is that predicting the timing of a squeeze in any market, commodities, stocks, whatever, is extraordinarily difficult even for professionals who do this full-time. Markets can remain in unusual positions for much longer than most people expect. There are also players on the other side who understand these dynamics and actively work to manage or prevent delivery squeezes. The COMEX itself has rules that can be adjusted, delivery options that exist, and the CME group has in the past changed margin requirements or delivery terms during periods of market stress. In other words, the system has safety valves. They don't always prevent a big move, but they do exist and they can matter. There's also the perspective worth considering that large short positions don't always represent naked speculation. Some of those shorts belong to mining companies that are hedging their future production. They know they'll have silver coming out of the ground in 6 months, so they sell it forward to lock in a price. That's a completely rational business practice, and it doesn't create the same kind of vulnerability as speculative shorts. When you're analyzing the COMEX positioning data, it can be difficult to separate the hedgers from the speculators. And that distinction matters a lot when you're thinking about squeeze potential. What we can say is this: the conditions that have historically been associated with sharp, unexpected moves in silver prices are present to a meaningful degree right now. Whether those conditions produce a dramatic event, a gradual repricing over time, or ultimately get resolved without much fanfare, that's genuinely uncertain. And anyone who tells you they know for certain which of those outcomes is coming is probably overconfident. So what's the takeaway here? What does this actually mean for an everyday investor trying to make sense of their financial picture? Here's the mental framework I'd offer you. Silver is not a simple asset. It's not just a commodity, and it's not just a financial instrument. It sits at the intersection of industrial reality and financial architecture, and when those two worlds fall out of alignment, when the paper claims outpace the physical reality by a wide enough margin, the potential for a correction grows. That correction can come through a price spike if physical demand surges. It can come through a slower repricing as the market digests tighter fundamentals. Or it can come through some kind of market structure event that nobody quite predicted. The key insight is that the COMEX inventory situation and the short positioning are not just abstract numbers. They represent real obligations, real physical constraints, and real financial exposure for the institutions that hold those positions. When the gap between paper and physical gets wide enough, it tends to matter eventually, even if eventually is hard to put on a calendar. The other thing worth keeping in mind is that silver, because of its dual nature, tends to be more volatile than gold. When the economy is strong and industrial demand is humming, silver can outperform gold significantly. When fear enters the market and investors run to safety, gold often does better. Silver tends to catch up dramatically when both industrial demand and investment demand are moving in the same direction at the same time. And if a delivery squeeze were to overlay those conditions, you could see moves that are genuinely historic. But again, and I'll keep coming back to this, the timing of all of this is not something anyone can reliably predict. What you can do is understand the dynamics well enough to make informed decisions about how or whether this fits into your own approach to managing your savings and investments. That understanding is worth having, regardless of what the market does in the near term. Let me also touch on something that I think often gets lost in these conversations, which is the broader context of why physical commodities are drawing more attention in 2026 than they might have 5 years ago. A lot of people are looking at the overall financial landscape, the level of government debt globally, the pace at which central banks have expanded their balance sheets over the past decade, the inflationary pressures that have made purchasing power a real concern for working people. And they're asking whether assets that are physically real, that can't be printed or created by a committee decision, have a different kind of role to play in a diversified financial strategy. Gold has always been the traditional answer to that question. But silver offers some things gold doesn't. It's more affordable per ounce, which makes it accessible to a wider range of people. It has genuine industrial utility, which means its demand isn't purely sentiment-driven. And precisely because it's less liquid and the market is smaller than gold's, it has historically shown the ability to move more dramatically when conditions align. None of that is a guarantee of anything. It's context. It's the kind of context that helps you understand why serious institutional analysts and fund managers are paying attention to the silver story and why that attention has been growing in 2026 as the inventory data has continued to trend in the direction it's been trending. Here's the summary I want to leave you with. Physical silver inventories at the COMEX have been declining, moving in a direction that narrows the gap between what's actually available for delivery and the scale of paper contracts outstanding. Industrial demand for silver from sectors like solar energy and electronics is structurally elevated and likely to remain so. The supply side of silver has real constraints and can be slow to respond to price signals. Large short positions in the silver futures market, while not inherently problematic, become more meaningful when the available inventory to deliver against those positions is thinner than usual. The combination of these factors creates conditions where a demand surge for physical silver could produce a significant market event, though the timing and magnitude of any such event is genuinely uncertain. Understanding this doesn't require you to run out and do anything, but it does equip you to have a more informed conversation about what's happening in one of the more interesting corners of the commodity market right now. And in a world where financial literacy is increasingly important for everyone, not just professional investors, that kind of understanding has real value. If you found this breakdown useful, I'd love to hear your thoughts in the comments. What aspects of the silver market are you most curious about? Are you someone who already holds some physical metal, or is this the first time you've really dug into how these futures markets work? Let me know, because your questions and your perspectives genuinely shape what we cover next. I also want to be clear, as I always am, nothing in this video is financial advice. This is education, information, and analysis. Every person's financial situation is different, and any decisions about where to put your money should be made carefully, ideally with the input of a qualified professional who understands your specific circumstances. The goal here is always to help you think more clearly about the world, not to tell you what to do with your money. Thanks so much for spending this time with us today. This is John Smith, reminding you that the more you understand about how these systems work, the better equipped you are to navigate them. We'll see you in the next one.